It's still hard to predict whether the United States will experience a soft landing or a recession. The fact is that the US dollar issue has become relevant once again. In July, non-farm payrolls seriously undermined the picture of the exceptionally resilient US economy in the face of high central bank rates. Later, as the new macroeconomic statistical data was published, these fears somewhat faded but did not completely disappear. And this seems logical given that the published indicators did not align with the forecasts. For instance, yesterday's manufacturing report showed a rise, though falling short of expectations, marking the fifth consecutive month of activity decline. As a result, the US dollar stayed around 101.70 points. Let's find out what obstacles the US currency may face in the near future. We will also examine how macroeconomic reports due on Thursday, September 5th, could affect the currency market. You are watching Traders Calendar. The trading day will start with Australia's trade balance report. The indicator is expected to drop by almost 600 million Australian dollars. Australia's economy is closely tied to the Chinese market. That's why falling demand from its key trading partner reduced Australia's exports to China by 4.2%, although the Australian economy remains in a trade surplus, and this decline is likely to weaken the positions of both the Australian dollar and the New Zealand dollar against the greenback. The next important report will be released in Germany. According to analysts, the anticipated data could be very negative for the euro. Since German automaker Volkswagen is considering closing factories in its home country for the first time, this could be a serious blow to Germany's government and the European economy as well. A drop in factory orders to minus 1.5% from a 3.9 is likely to drag down the euro as well. 3 hours later, the Eurozone will disclose its retail sales figures, which are also of great importance. Forecasts suggest a jump in consumer demand in August. Thus, the indicator is expected to climb to plus 0.1% from a minus 0.3 year-over-year, compared to the same period last year. The monthly figures look the same. Therefore, the euro is likely to see a rise following the release of this report. However, the euro is unlikely to enjoy its small victory over the dollar for long. US reports scheduled for the same day are expected to favor the greenback. For example, the ADP non-farm employment may rise to 145,000 from 122,000 people. Notably, traders have been paying close attention to the US labor market data following the previous non-farm payroll figures. Thus, even a secondary indicator like this one could trigger volatility and lift the US dollar. US initial jobless claims data, which is now issued daily, has the same influence on the market. A rise in the number of new claims signals a weakening labor market, a cooling economy, and a falling dollar. Conversely, a small drop in the number of claims compared to the previous week could bolster the US dollar, thus strengthening its position against 6 other currencies in the basket. However, the contradictory nature of the US macroeconomic data, as we mentioned earlier, will once again cause trouble for the greenback. The US services PMI is expected to decline slightly to around 51.1 points. At the same time, this sector of the US economy remains in the expansion zone, above the critical 50-point line. Interestingly, last month's employment in the services sector rose for the second time this year to 51.10 points from 46.10 points. This in turn raises doubts about the weak jobs report that caused serious concerns about the health of the US economy. Please note that the time of publications is set in a GMT +3. The next video review of Traders Calendar will be released on Thursday, September 5th. We will monitor the market reaction to the above-mentioned reports, subscribe to our channel, and follow changes in market sentiment with us. Any comments, questions, and offers are welcomed. We wish you profitable trading and see you soon.